Chairman and MD of Kerala Finance Corporation and Deputy CEO of Kerala Infrastructure Investment Fund. In 2018, Sanjeev Kaushik was appointed whole-time member of SEBI. Mr. Kaushik has a rich stint of 12 years in global investment banking as Managing Director of Equities at HSBC and as MD of Lehman Brothers in Mumbai. Mr. Kaushik has done his MBA from London Business School and Mechanical Engineering from BETS Plenary. Welcome, Mr. Kaushik. I would also like to welcome the moderator for this panel session, very well known amongst us, Ms. Girija Srinivasan. Girija ji has been a development banker for more than a decade and now into successful international consulting practice in India and overseas. Her areas of interest are rural livelihoods, rural banking, financial inclusion, and community-based organization of women and farmers. She also has authored several reports individually, jointly. These include books as well, studies especially on SHG bank linkage programs. As an international expert, she serves as a consultant and advisor to International Fund for Agriculture Development, GIZ, NABARD, MicroSave, Frankfurt School. I can go on, and so I heartily welcome Girija Srinivasan as a moderator for this panel. Also on this panel is very well known to us, Dr. Smita Premchander. She is the lead researcher for the study that will be presented today during the session. And we know that she's a development consultant with over 36 years of experience. She's a practitioner, researcher, teacher, and advisor on issues ranging from microfinance, poverty reduction, social inclusion, child labor, gender equality, and women empowerment, and also food security. She has an internationally diverse work experience, has worked with agencies such as ILO, BRAC, World Bank, NDDB, and CARE India. Welcome, Smita ji, to this session. With great pleasure, I also welcome Greta Bull. Good morning, Greta. Welcome to this very interesting discussion that we are all looking forward to. Greta is the Director of Women's Economic Empowerment at the Bill and Melinda Gates Foundation. Prior to Gates Foundation, Greta served as CGAP CEO through July 2021. She has 20 years of experience in development finance, primarily focused on small and medium enterprises, microfinance, and digital financial services. She has worked in several continents with financial service providers as well as policymakers in Latin America, Central and Eastern Europe, Sub-Saharan Africa, and of course, South Asia. Greta has a master's degree in public policy from Harvard University, the JFK School, and an undergraduate degree in international studies from the University of Washington. It's my pleasure to welcome you, Greta. Also on panel is Ms. Mehnaz Safavian. Mehnaz is the lead financial specialist with the World Bank, and she has worked with the World Bank Group in multiple regions and covers MSME finance, infrastructure finance, creditors' rights, and financial inclusion. Prior to her tenure with the World Bank, she worked for the US government, academia, and in the non-profit sector as well. Mehnaz holds a master's and PhD in economics and continues to publish in World Bank publications and academic journals. So I welcome all of you. I also welcome all the audience from India and overseas who have joined in for this session. We look forward to a very, very exciting session and discussion. Over to you, Girija ji. Before that, I would also like to say that the study that is being presented during this session, we are going to virtually release the executive summary of the session, and the main report will follow shortly. So I request the virtual release of the executive summary of the study. Do I declare it released?
Yeah, please go ahead, Meena.
Yeah, so we do declare it released, and over to you, Girija ji. Wishing a wonderful discussion ahead. Thank you very much.
Thank you, Meenal, and welcome the esteemed panelists, welcome audience. I think what we are missing only is, the face-to-face interaction with the audience. We hope that you share your thoughts and also your queries with us. Don't wait till the end. Please keep sharing, and we will be able to see them and take up your queries. This is, as Meenal mentioned, a very important session because this is the topic is something very, very close to our heart and very important for the development of the country. Micro enterprises are the largest employment generators in the country. Women entrepreneurship in particular is very critical for India because it catalyzes women's participation in the labor force, especially at a time when India's female labor force participation rate is at a historic low. India ranks 136th among 144 countries in this metric. Globally, women's contribution to GDP is at 37%, while in India, it is less than 20%. Women's enterprises matter to the country now more than ever when the employment and job demand is expected to peak this decade. The gender gap is very stark in the enterprise space. Women-run enterprises have a low share in the total enterprises in the country, as government surveys and other studies show. The best estimate is 20% of the enterprises are owned by women. Studies show that the major hurdle in setting up and also scaling up is access to finance. Though India has a robust financial landscape with a number of public sector banks, private sector banks, cooperative banks, non-bank finance companies, small finance banks, fintech players, they are lending to enterprises. The small finance banks and the Mudra Bank were set up to encourage more credit to the enterprises. However, more than 85% of the debt to women enterprises is from informal sources, money lenders, chit funds, etc. The estimates show that there is an unmet demand of 185 billion US dollar of credit for the 150 million women enterprises. Formal financial institutions definitely seem to have some constraints in lending to women enterprises. Women's enterprises usually are in the lower spectrum of micro enterprises, going by the metrics of capital invested and also sales turnover. They are usually unregistered, operating as informal enterprises. There are apprehensions that the recent change of definition of micro enterprises and also mandatory registration in government portals to be eligible for priority sector lending has a trade-off in terms of financial institutions lending to larger enterprises, crowding out the smaller sole proprietorships where women largely are operating. But currently, thanks to the microfinance movement, women have access to credit. About 122 million women are part of self-help groups, which is largely rural focused. Although it may vary with regions and locations, it is estimated that about 20% of the SHG members have the potential to grow as true entrepreneurs. However, for a program which is 3 decades old, it is not a matter of pride that most of the women entrepreneurs have still not been able to access larger loans which they deserve. What stops the financial institutions to finance these women entrepreneurs adequately and with appropriate products when they have proven credit history of taking loans through the SHGs? The other part of microfinance sector is the MFI model, which reaches 70 million women through joint liability groups in both rural and urban areas. Many women nano enterprises access loans from MFIs. However, this is a high interest rate, mutual guarantee model with transaction efficiency coming from group lending and standardization. These institutions need to graduate their borrowers to larger ticket size, lower interest rate individual loans without the intermediation of the group. World Bank has commissioned a study on how can we make formal finance flow to women enterprises? The study has been carried out by Access Assist. Let us hear from Dr. Smita Premchander the results of the study. We will then have panel discussions on study findings and also on global best practices and learnings from other programs that has worked well. Over to you, Dr. Smita.
Thank you, Girija. Thanks very much for inviting me, and also thanks to the World Bank and Access for having our team conduct this study. It was indeed a very intense and a very, very interesting experience to actually learn from supply side challenges, because, you know, there are a lot of studies which give you the women's perspective, but there are not that many that, you know, investigate what are the problems that the financial institutions face. So from that point of view, it was really, really interesting to do the study, and we had a very large team doing the study. I would like to take you to some of the first things that Girija started with. What is the need for you know, giving more loans to women? Actually, women's contribution to GDP, as Girija already told you, globally it's 37%, but for India it's only 18%. That's not only because of the labor force, but also women's self-employment and enterprise doesn't get as much finance as it needs to get. And also in the Global Gender Gap Report, India used to be 110 ranked, and now it's ranked 151 across, you know, in the ranking of countries. So basically, poor access to finance is really the one very strongly responsible for constraints of economic participation of women. That said, we also have to remember, and many institutions told us, if there are not enough women's businesses, how do we go and finance them? So finance is an industry that, you know, that follows the real manufacturing and services industry. So in the MSME sector, 30% of India's GDP is in the MSME sector now, and all majority of these enterprises are owned by men, both in urban and rural areas. And if we see the proportion of women-owned enterprises, as the sizes go up, the proportion of enterprises owned by women go down. So they are 20% in the micro sector, as Girija was saying. But now when you move to the small size enterprises, they go to 5%. And when you go to medium sector, then actually women own only 3% of the total enterprises. So the gap between demand and supply is also about 116 million, as the IFC report shows us. So I'll bring you then into what we did in the study. And the first thing we did was a lot of literature review, studied a lot of literature, and there were certain themes emerging. And then we also spoke to women entrepreneurs in FGDs, and we spoke to several institutions. But we started first with speaking to women entrepreneurs themselves. And from there also ratified that these study themes are actually relevant. The first one, which came across very strongly, is that you know, gender disaggregated data on loans from formal financial institutions is very, very difficult to get, because many of them, they just don't keep it, or they don't analyze it. I'm sure it must be there somewhere, but it's not available in public domain. Outreach and awareness was a major issue. How about institutional policies and staff attitudes? These came across very important issues. Appraisal processes, product development and delivery to women's enterprise, and then non-financial services and linkages was a very, very big area of work as well, and support from government schemes. So we did speak to 10 categories of financial institutions, but they also included networks, and they also included development financial institutions. So we spoke to 28 institutions, and we conducted 6 focus group discussions with women. what we found is that we could by and large do a spectrum across which we could see that there are some institutions which are completely gender agnostic. So they're giving enterprise loans, but they do not consider women as any important category to separate and think about. Then there were organizations which were doing some amount of gender sensitive lending. And then there were organizations on the other end of the spectrum where we could say the policies and practices and products and systems were actually looking at, thinking about, talking to and dealing separately with women's needs and offering them completely tailored products. So on gender segregated data, we found that there were organizations which had no recognition of different needs of women, were not collecting any data. There were some which had recognition and partial attention to some needs of women. And then there were organizations which were really analyzing, looking at, collecting the data and tailoring their offerings systematically. So essentially, unless we collect gender disaggregated data, it becomes very difficult to identify existing gender disparities and formulate policies for financial inclusion. So this is really important for policy as well as better designed products and services to actually address the gaps in data collection. On outreach and communication, again on the same spectrum, we found organizations which are again completely agnostic. They do not see the need for having outreach strategies which will cater to the needs of women and see whether they're reaching enough women or not. And on the other hand, we did have organizations that were looking at when do women come. So we had good practices shared by people, by organizations, saying that they locate branches in places where women can come easily. They calibrate the timing so that women can come out of their housework and other times when they can reach, and not a 9 to 5 sort of branch opening. And information campaigns using channels like radios that reach women very easily, and also doing gender differentiated clients needs assessments. And then also important was the fact that women cannot be clubbed into one category, because women also have differentiated needs across geographies, across classes, across social segments. And so there were organizations which were conscious of this and tailoring their outreach and communication strategies accordingly. So and then this spectrum was really working for us in terms of analyzing. Again, in terms of institutional policies, we found that there were organizations which had no policy, nothing, no statement about outreach to women, entrepreneurs and finances to women, and were not their staff attitudes were similar. On the other hand, we had institutions, of course, which were completely loaning to women. And then in the middle were several organizations, for example, organizations which had moved, let's say, from NBFCs to becoming small finance banks. Now, we should not typecast this, because in a small study like this, it's very, very important not to generalize. But there were organizations which came from dealing completely with women into becoming small finance banks, let's say. So they male clients as well, but were completely conscious and very careful about the needs of the women clients as well. So I think it came out as very important that gender sensitization across all the staff levels at the institution is important. Greater participation of women in the decision making is important. And actually what is really, really important is if an institution actually commits to increasing loans to women's enterprises, because when they are not looking at this, and sometimes they also told us that we give loans to women's enterprises to the extent to which it is mandated by the government. Beyond that, we are not looking at this metric at all. So so this highlighted the importance of institutional policies. When it came to risk assessment and appraisal processes, again, there were very good examples, because in terms of risk assessment, it becomes very difficult because in the SHG format, SHG bank linkage, the data that is available is group wise, and that doesn't provide the information when the group member has to then progress to individual loans. It's easier in the JLG model, but in the SHG bank linkage, it isn't there. So cash flow data then was being used in the absence of collateral and credit history. These were some very good examples, but also came the demand that group transaction data must be provided through credit bureaus and so to establish credit worthiness. So, and then we found in product development and delivery, again, there were organizations which had no attention to gender while designing products. And then there were organizations which were only dealing with women. So they had a very, very good understanding of what kind of products women need. And they had tailored products like cash flow based repayments. There was a lot of adoption of technology, whether that was in collection of repayments, or that was in cash flow analysis, or that was in several other ways in which, for instance, risk appraisal or credit appraisal or KYC were also done on the basis of technology and long distance and so on. So then the other one which appears very strong is non-financial services, whether it's financial literacy, skill training, business management, digital marketing. Lots of services were being provided, but I have to say that not all these were provided by financial institutions. It was very important that NGOs were there. There were some World Bank projects. There are some projects with IFAD, and these are multi-sector partnership, multi-stakeholder partnerships through the government and through NGOs and so on. And these were predominantly important in building lessons towards how to provide non-financial services so that more and more women can get business loans. So I think that's pretty much the study from the financial institutions point of view. And there were a lot of government programs. So there were more than 20 direct financing schemes. There are several refinancing and even guarantee schemes and non-financial support schemes which are there. What we did find is that primarily the public sector banks go to these more often than private sector banks and or private sector institutions, even if they are not banks. For financial institutions, accessing government schemes is very time consuming and cumbersome. And we heard from them very strongly that actually they do not lack funds. They do not lack funds. It's
Smita?
Yeah, just give me
Can you
half a
conclude
minute.
in 2 minutes? Yeah.
Yes, in 2 minutes. Yeah. And lack of gender segregated data makes it difficult to analyze and reach the impact of schemes. So basically, I think I've told you the major recommendations. We need a holistic business ecosystem. We need pathways for graduation of women entrepreneurs to the MSME sector. There is a huge block. We need gender segregated data, and maybe we actually need a lot of women focused formal financial institutions because they appear on the right side of the spectrum. So thank you very much. I'll stop here, and Girija, over to you. And whenever there are questions, that would be great.
Thank you so much, Dr. Smita. I think in a short this thing, but you have really brought out, the critical position of where the financial institutions are now, and also the good things which are happening, and also what could be the game changers if women need to be financed adequately. Thank you very much. Now I turn to Sanjeev ji for your opening remarks, Sanjeev ji, on what is working well and what do you think are the still persisting gaps in women enterprise financing after listening to Dr. Smita?
Thank you, Girija ji, and what a wonderful panel to be associated with. Thank you for having me on this discussion. This is a wonderful and eye-opening study, I must say, Dr. Smita, and though I don't necessarily agree with all the points in there, but let me, to set things in the right perspective, I think I must take you back to the journey that has begun in the whole area of financial inclusion in India in 2014. If you look at the World Bank's Findex report that was released in 2013, India had only a 35% coverage of its adult population with bank accounts. But in 2014, our Honorable Prime Minister actually launched the Jan Dhan Yojana program. That was the basic accounts for unbanked adults. And today we have come to a stage where we have more than 43 crore Jan Dhan accounts. So we've made huge strides, which has even been recognized by the World Bank, which in 2018 released the next edition of the Findex report, in which our number was from 35%, we more than doubled it to exceed 75%. So we've made huge strides in financial inclusion. Apart from the Jan Dhan account for providing coverage, access to not just men, but also to women, to all our unbanked population, to basic financial services. We also launched the Mudra Yojana program in 2015. And then we also have the whole JAM Trinity, that is using your Jan Dhan accounts and the Aadhaar identity, and using mobile banking. Anyone across the country, even in the rural and remote areas, could access some of these financial services. Now, all of this is very important because, India is actually, I'm actually leading the ministry's efforts on financial inclusion, and we are very proud of what we've done. Now, social inequalities, gender disparities have, for historical reasons, have existed. And I'm not going to deny that there are gaps, but we are making all our efforts to close some of these gaps. In fact, women and the inclusion of women account holders, women for financial services, is the cornerstone of all our policies in financial services. To give you just one example, the Stand Up India program was launched in 2016. Now, the Stand Up India program, the whole objective was that each and every public sector bank across the country, each branch of that bank should necessarily give a loan to at least one woman beneficiary and one SC/ST, that is scheduled caste beneficiaries. Now, I know that this program, which runs for a number of years, is far from achieving some of the targets that were set out. But still, 1 lakh loans have been given to women beneficiaries under this program since 2016. And that's an amount of almost 25,000 crore rupees. So we are not yet there, but we have come a very long way. And through, in fact, if you look at the Mudra Yojana, which is the small business ticket size loans, more than 69% of the loans that are borrowed are by women entrepreneurs, which is a very, very significant achievement. So I think these two pieces of evidence from Mudra take-up and from the Stand Up India program tell us that, we are fast closing the gaps. Now, just to give you the most recent example of last year when the pandemic hit us and we had a lockdown, government was faced with the challenging task of reaching out emergency cash to households across the country to facilitate the household expenses to be met. And what we chose to do? We actually chose to transfer the direct benefits, the cash, into the accounts of women holders of Jan Dhan accounts. And more than 20 crore women Jan Dhan account holders received almost 31,000 crore rupees in that period of 3 months from April to June of 2020. And that just goes to show that, how important, how focal it is, the role of women, not just women account holders, but also women entrepreneurs in all of what we do as far as policy making is concerned. I think I will just close my initial remarks by saying that, yes, there are gaps, but we are fast closing that gaps, and women remain the cornerstone of policy making as far as the Ministry of Finance and Government of India is concerned.
Thank you very much, Sanjeev ji. I think the financial inclusion space, what India has achieved, I think world is looking at us, especially the strides which we made in opening individual savings bank account in the name of the women, and also the aspect which you brought out during the Corona COVID times, how billions of dollars were transferred to the women's account, utilizing this huge architecture which the Ministry of Finance has set up. It is really worthy. But the only aspect which we want to highlight is somewhere financial inclusion is not automatically translating into adequate finance for the women's enterprises. There could be a number of reasons for that. And this session, we would like to explore some of the constraints which the financial institutions face, and what exactly do we do so that, that if only 20% of the enterprises are women owned now, in the next decade, can we look at 40%? Can we achieve that many numbers, double the women owned enterprises? So that is the question before the panel. But thank you very much for your, highlighting what India has achieved in the financial inclusion space. Now I turn to Greta. Greta, you have listened to Dr. Smita, and you have such vast experience in several parts of the globe. So what do you think is working well? And where do you think there are persistent gaps in financing the women enterprises?
Thank you so much. Can you hear me? Okay, good. So yeah, I'm gonna maybe bring a global perspective to this and then narrow it down a little bit to India. You will all have much deeper knowledge of India than I do. So, the question that was put to me was, what's the state of financing of women around the world? And frankly, I think it's not great. And that's not least because there's so much that we don't actually know. We know at a high level that men and women have pretty unequal access to credit, and that there is quite significant demand for credit among women-led enterprises that's not being met. We also know that women's enterprises have been hit harder by the pandemic than men's enterprises. There's a pretty good evidence base for that. But these are pretty broad brushstroke figures that are good for mobilizing people around a broad direction of travel, but pretty hard to take more nuanced action against in individual country contexts without knowing a lot more. We don't know who these women are or what their enterprises really need, as was pointed out before. And I'd like to touch on something that Smita talked about in her presentation. It's partly because we still talk about women like they're one giant segment. Half of the world's population is not a segment. A woman who runs a medium-sized formal enterprise in Johannesburg or Cape Town is totally different from a rural woman running a small shop as a side hustle to farming in Bihar. So we have to get a lot smarter about being clear about what we mean when we talk about supporting women's enterprise, and we need to provide more nuanced solutions for those different segments. Because those gender gaps are actually being driven by a plethora of factors. Some of them are common across different segments and incredibly tangible. For example, in some markets, women unbelievably still can't own accounts or pledge land as collateral without their husband's approval. But then, more broad and less tangible, but still quite insidious social norms that mean in some countries that women actually can't do something as simple as traveling outside of the home unaccompanied. And let's just all remember too that this so-called sort of developed world is not exactly miles ahead in this regard, right? So in my own country, the United States, it was only 1974 that a woman in the US was able to get a credit card in her own name. And in 1978, was it possible, or well, was it made illegal for a company to fire a woman for being pregnant, which mind-bogglingly was pretty fairly common practice at the time. And that's within my lifetime. So these are not new challenges, right? So what are the things that I think will help to change this equation? Actually, first of all, and this seems sort of obvious, but I think it's worth stating, we need to make sure that all women are able to earn and control an income. There is absolutely nothing more empowering than being able to support yourself and having to make decisions with the money that you earn. So finding opportunities for women to earn their own incomes is crucial. For many poor women, that pathway is either through selling her labor or through an entrepreneurship pathway. And today we're mostly focused on that entrepreneurship pathway. Central to running a business is the topic of credit, because as any small business owner will tell you, affordable credit on reasonable terms is pretty fundamental to running a business and making a living from doing it. As we think about orienting the financial sector towards doing a better job on financing women's enterprises, I think there are a few really important levers that we can pull, and I would put them into sort of three buckets. One is smart public policy. So public policy shapes the environment in which providers operate and helps shape the incentives. An enabling and well-structured regulatory framework is common in many markets where microfinance thrives. We at the Gates Foundation are about to embark on some work on this, but you can see a thread running through countries that have robust microfinance segments almost always have a pretty good regulatory framework and a good regulator. Smart wholesale funding that recognizes that reaching poor women is hard and therefore protects institutions and borrowers from both high borrowing costs and excessive Forex risk. Not so much a problem in India, massive problem in Africa. And then regulatory incentives that enable a focus on lower income segments without taking on a heavy regulatory burden. And again, regulatory structure matters a lot in that context. As has also been stated, good shared market infrastructure is a really important factor. The ability to make and track payments, visibility into credit histories, good ID systems, cash in, cash out infrastructure is also very important for women. And so, to be honest, I think India is getting quite a lot of this right, but I think there is also still a lot more to do. And this kind of speaks to the challenge of data, because I have completely different numbers that were shared earlier. But I think undeniably, I won't go into the numbers. But the self-help group ecosystem has reached large numbers of women. The number I have is 80 million low-income women who've gained access to affordable credit on very affordable terms, I would add, which quite frankly, micro enterprises in Africa can only dream of. But that doesn't necessarily provide the kinds of resources that more structured micro enterprises need for working capital or building assets. So we need to think about how we connect the dots with more formal lending mechanisms that sit in MFIs and NBFCs. And that opportunity is pretty considerable. Again, an estimate that I saw from the Ministry of MSMEs found that outside of the self-help group movement, they estimate there are approximately 63 million MSMEs in India, and that women manage 8 million of them. And in an estimate I saw from the IFC, these enterprises have unmet demand for credit representing 9 billion. The numbers are big, no matter how you look at them. The good news is I think the pieces are coming together in India in a really interesting way to continue to build out a more inclusive financial services ecosystem that meets the needs across the spectrum, from low-income women in medium-sized enterprises. And so it's a pretty exciting time to be in the microcredit space right now, but it's also not without risk. So as you grow this ecosystem, careful consideration of the policy environment will be pretty crucially important at this stage. Two more quick points. To have smart public policy, or indeed better private sector decisioning, you need data. Data is the big lever for the future of finance, and we're only just beginning to scratch the surface of the power of what data can do. Having sex disaggregated data is important at the country level for making better public policy, at the enterprise level for facilitating more effective delivery of credit, and at the individual level for empowering customers with their own credit histories. Luckily, India is very much at the forefront of this new wave of data-driven decision-making. And we'll, I think, have time to talk about that a little bit more later. But bottom line, if you can't see a problem, it's very hard to know how to solve for it. And then my last point is investing in specialized institutions. I think it is really hard for a bank to think about serving low-income populations. A bank just has so many better ways to make money, as was amply demonstrated in the presentation earlier. Serving the mass market looks expensive and risky when you have all of those other options available. In most African countries, the business model is lending to the government, frankly. So why would you bother with the hard work of reaching small enterprises? So I think there's immense value in having specialized institutions that serve different segments of the market. And we need non-bank financial institution models that allow providers to come in with lower regulatory burdens so they can build the kind of scale that enables them to eventually start taking deposits and taking on the heavier regulatory burden that comes with that. And by getting liquidity into the hands of these providers, as India does through its priority sector lending mandate, it means they have real money to work with and can, at least in theory, get to scale. There are many cases of lending NGOs turning into NBFIs and eventually transforming into banks. It's a very common pathway in Latin America, and it's emerging as a pathway in India too. We know that it works, and it's really about creating a regulatory pathway that allows you to do this and having a regulator who's able to keep a careful eye on what's happening in the sector to make sure it's developing in a healthy way. Again, I think India has been pretty thoughtful on this, but there are good lessons from other places around the world. It's not perfect, but definitely doing well against another of those objectives. So I will stop there because I think we'll get into some of these other topics in more detail later in the session. Thanks.
Thank you, Greta. Thank you very much for bringing this global perspectives and also, highlighting some 2-3 very critical points on we need to really understand the different needs of different segments of women. The data part is very, very crucial. And also we need specialized institutions. I'll have follow-on questions to you later on this. Thank you. Mehnaz, over to you.
Thank you so much. And just first of all, thank you so much for inviting me to join this panel. I know and have met all the panel members, and I know how much passion and thought has gone into this particular topic. So it's really an honor to be here. It's also the hardest slot to give me the last slot after all of the other panel members have gone. So I had a set of talking points, and of course they've already been mentioned by everybody. I thought they were really bright and illustrative, but they've already been taken up. So I want to kind of give a little reflection to a few points that maybe were said that I'd like to emphasize a little bit more, or maybe weren't said. And just maybe to stipulate, first of all, I think the overview that Sanjeev gave on the government of India is really spot on. And watching the evolution of financial inclusion, as I've been doing for many, many years, I've worked on India for quite a long time and left and come back. It's really been a revolution, and we look at it as a revolution in India. And we try and take those lessons other places. And the frontier that India is pushing continues to be pushed. So that's so exciting to be part of that journey, and to take those lessons to other jurisdictions. So I just kind of wanted to start on that. And having said that, and the progress that we've seen, obviously there are some pretty stark numbers that were just mentioned in the report, which we're proud of the findings of the report. But we commissioned that report specifically because we can't get our heads around the fact that there are only 20% of businesses in India that are run by women. This is not acceptable, and it's also not understandable. And so that's part of the reason why we actually, became in discussions with Access to try and drill down and get our heads around why this is happening. And the second point that I think was really interesting coming out of the study was we say 20%, but that's 20% of micro enterprises. So once you go to the small or the medium category, the number drops even more dramatically. So I would almost put it next to zero. I mean, these are probably exceptions. And as we know from other countries, a lot of times if a woman is on the title, that doesn't mean the woman really owns the enterprise or is running it. So likely these are bigger numbers. And maybe the third point I'd like to make is, over the past few years in India, we've been looking at this issue. It is impossible to get the data. So if you go to a financial institution, public sector, private sector, it doesn't matter. The data does not exist, and we have tried looking for it. So this is just, I know we're going to hear it over and over again. What you can't measure, you can't reform. There's no business case to be made because we don't have data, so we can't even make the business case. We don't actually know who we're reaching. I mean, the gap in our knowledge is also very striking and also, in my opinion, not acceptable. We need to do better here. So thinking about trying to be a little bit more solution oriented, and again, acknowledging how far India is, and I guess we just want to push the envelope a little bit. I would say that there are maybe 5 points that come to mind when I think about trying to crack this problem. The first one is data, and so that's been discussed at length. I'm going to keep bringing it up just so people don't forget, and I say it all the time because I think repetition eventually will sneak in. The second is technology. Why are we still doing collateral-based lending in certain institutions? Why do assets and someone's ownership of assets replace good underwriting? it doesn't have to be that way. And we know how to do it differently. Technology is the solution. And if financial institutions aren't using that technology, they're giving away profits, they're giving away money, they're losing revenue. Those who are using technology, which includes banks, but the fintechs are doing amazing things and really reaching into certain segments of the population that haven't been reached before. So we can, I could name institutions across India that are at the cutting edge, not only of women, but like women in specific sectors, women of specific loan sizes. So to me, technology is the second answer. The third one is scale, and scale is really hard to crack. So many of these institutions that we're looking at and many of the financial products are in early stages. And I don't think they've hit the numbers that we would like to see. And so right now, the majority of loans are kind of still in that traditional collateral-based, normal underwriting. The innovators are there, they're doing work. How do we grow them? How do we grow the MBFCs? How do we grow the fintechs? How do we get them to the scale that we'd like to see? And we have some ideas on that. The fourth point I'd like to make is the pipeline. Every time we talk to a financial institution, and our colleagues over at IFC are very, very interested in supporting institutions that reach out to women. And invariably they come back to us and they say, the pipeline in India is so thin. How do we build the pipeline? And I think that's really the missing half of the finance story, is the entrepreneurship story. And again, I have some views on that I can talk through later. And the last point I'll make is we need to look closely at the institutions. And I've learned a lot from looking at different institutions around the world. And you don't really see governance well represented in the banking sector. I don't know how many women are on financial institutions boards. Actually, we should commission that study, but I do know when I look, I don't see a whole lot of women. And I don't see people of color or who look like me or who look like some of the other panelists. There's just not enough diversity. Then you start looking at senior management and you say the same thing. And then you start going down to the loan officer level and you still see the same thing. Until the brains of the institution, the structure of the institution starts looking like women, then they're probably not going to think women are a priority. I don't think there's a public policy answer to that necessarily, but there is a kind of a social cohesion answer to that. So I would also like to leave the panel with those thoughts for the opening remarks. Thank you very much.
Thank you so much, Mehnaz. I think wonderful points, and particularly on data, on it is a little sad to hear that your IFC colleagues is not able to build a pipeline, though there are number of institutions in the financial landscape. Let's talk about this when we come to the next this thing. But more importantly, I think the point which you raised about women being there in the governance, in the management, in the frontline staff, unless these are well represented by women, we cannot expect much financial services for the women. Thank you very much. Now I turn to Sanjeev. Sanjeev ji, there are a couple of questions from the audience. So I thought I would break it in now. One is, it is somewhat interlinked about the government policy. One is, whether the women entrepreneurship schemes, there is interest subvention getting provided by the government. Will it lead to better access to finance for women, or would this lead to diluting the credit discipline? So this is one question. And also a kind of related question on credit discipline is, because the SHG lending program now has a lot of credit interest subvention and also high delinquency rates in several pockets. Is that the reason why the banks are hesitant to graduate the women from SHG-led model to the MSME lending? Over to you, Sanjeev ji.
Thank you, Girija ji. But With your permission, before I actually answer those questions or sub-questions, this issue of data availability, I would actually like to say that, you know, in all our schemes and in all our surveys, whether it's the National Family Health Survey or Census, we have all the various required splits of data. So, for example, I could tell you very readily how many women account holders are there. I could tell you how many women mudra borrowers are there. I could, if you talk about our micro insurance schemes, the social security schemes, I have the exact disaggregated data for you know, gender, etc. So in most of the schemes that at least we deal with in the Ministry of Finance, we do make it a point to have the disaggregated data. So it's a bit surprising to me that this issue keeps coming up. Maybe the financial institutions have not been very forthcoming with that, but I know that all of our banks and insurance companies do actually maintain this data, and we also centrally collect all this. So I'd be quite happy to share some of those figures offline separately. But let me come back to the questions that you raised on interest subvention and on credit discipline especially. In terms of interest subvention, I think our findings initially were that collateral is a big problem for women. Of course, low-cost fund availability is very important, but if without a collateral, the financial institutions were not even willing to look at women borrowers. It was precisely with this intention that the Mudra scheme for loans, for small loans up to 10 lakh rupees was launched. And there is absolutely no collateral requirement for up to 10 lakh rupees because this is a government guarantee which is given through a trust called the CGTMSE trust. So up to 10 lakh rupees, there is no requirement of collateral. Under the Stand Up India scheme, we try to graduate the small borrower, women who are small borrowers to slightly larger loans, which is also a problem that I think Mehnaz was raising or one of the earlier speakers. Where the ticket size actually goes up to 1 crore rupees, that is 10 million rupees. And there also absolutely no collateral is required and it is government guaranteed loans. So the first thing is that one of the biggest stumbling blocks is availability of collateral as far as women borrowers are concerned. And through these programs, we've tried to address that. In terms of the actual cost of funds, no, currently there is no interest subvention which government has made available for women borrowers. But then we've come out with guidelines under co-lending schemes which apply to both men and women. Now, co-lending, basically we are expecting public sector banks and other banks to tie up with NBFCs and MFIs. And the whole point is to blend the cost of funds of the NBFCs, MFIs, which are higher, with the cost of funds of banks, public sector banks, which are lower, in the hope that the weighted average cost of funds, which ultimately the women borrower gets, or any borrower gets for that matter, would be much lower. And the third point was about credit discipline. In fact, I would say that credit discipline is probably much lesser of a worry as far as women borrowers are concerned. In our experience, and particularly if you look at the self-help groups as collectives, the default ratio is negligible. In fact, women are very, very good repayers of the money that they borrow. Now, even if you look at the individual loans that are taken by women as individual entrepreneurs, default ratios that we have are not at all significant, and there is nothing which raises a red flag. So I think in terms of credit discipline, financial institutions do not have a worry. But the point that was raised about representation of women as far as the staffing and decision making is concerned, in fact, across public sector banks, we like to think we have a good mix of women in the staff. I don't readily have the exact proportion, but there is a very large number of women staff and also leaders, MDs and CEOs of some of these banks. We've also got a very vibrant BC model, that is the banking correspondent bank Sakhis. The banking correspondents are the arms of banks which reach out across the country. And we also have something called bank Sakhis, which are the women BCs which reach out specifically to women entrepreneurs and women account holders. So that's a very vibrant area as well. And yes, we are conscious that increasing the representation of women and having, women appraise, hopefully women appraise the proposals that come up would probably also be very, very important as far as lending to the women are concerned. So these points are well noted.
Thank you very much, Sanjeev ji. I think, there are 2-3 pathways which are opening up. But I think we would take up the data issue first, and then we will move on to the next 2 questions on, how do we graduate women from the SHG or JLG mode into an individual loan? That is definitely something worth looking at for this panel. And also the whole issue of, women being better clients, better repayers, but when it comes to enterprise financing, so little seems to be flowing to the women. So the better repayers is more for microfinance, where automatically women are the chosen clients. But when it comes to the enterprise financing, women seem to lag behind. These 2 issues we definitely need to talk about. I think the data points, definitely it has been improving as far as the gender disaggregated data is concerned. The point I think which Dr. Smita as well as Mehnaz have been mentioning, Sanjeev ji, is about the various cuts of, how do you, even women as a whole is not one segment. That is number 1. Number 2 is, we do have outreach data, no doubt about it, for different schemes, insurance, pension, credit, Jan Dhan Yojana, several this thing, we do have the outreach data. But then when we talk to the banks and also the other financial institutions on actual usage of, how women use or how men use these products, or what are the customer preferences for certain products and certain features, whether you have adequately researched, whether you do develop much more customer orientation, women orientation in developing products and services, there we are not heading much. So these are the points which I think Dr. Smita and Mehnaz were highlighting. And it is very important that unless we have enough data on products and on services, the financial institutions cannot come up with useful products or even marketing strategies. So this was the point which was, being made. But I turn to Mehnaz. You see, India has some fantastic technological capabilities, but then still we seem to be lagging behind when it is data capture and data usage. So do you know of any other country, because you the bank is looking at several countries, and enterprise financing is something very core to the bank's financing. So are you aware of any other country or large program, Mehnaz, where such MIS is available? And do you have any suggestions for us?
So I think when we talk about women entrepreneurs or women enterprises, when we talk about data, it's big. So what are we talking about? So first of all, I think there's the data on repayment behavior and credit history and the types of transactions that people do, not only credit transactions, but transactions across the board that actually build their credit history up and allow banks to do better underwriting. So I would say that's the first category of data that I would think about. And then I think the second category of data that is also really important is to know your clients and how much the financial institutions actually do know their clients. Do they collect gender disaggregated data? Do they analyze it? Do they analyze repayment rates? Do they analyze usage? Are they looking at, there are a whole bunch of potential areas to explore within that data. So I would put that as kind of the second bucket of data. And then the third bucket of data is kind of around public policy and having a more global view of what usage looks like across the country, but maybe not according to financial institutions. And so on that last area, I would completely agree with Sanjeev. You can find a lot of really interesting data here in India from kind of a larger global perspective, and really that can tell you a story. And what that story is that's telling us is that we have a problem here, that somehow we're not either reaching our market, our target market of women, and again, different submarkets, or our market is too small, right? It's one of those two. Either our market exists, but we're not reaching them, or our market's so small that we're reaching as many as we can, but we need to grow the market. I don't think we know the answer in India to which one of those is the problem, but the fact that we can't answer that is telling us something. And to me, that goes back to the other two data issues. What is happening within the institution that we could understand at kind of a micro level, and how can we learn more about those types of clients and customers? And really also on that third, India has done an amazing job with data aggregation and going sort of across the board. So I don't want it to seem as if there isn't tremendous progress here. But there is still a really large gap. And I know there's a large gap in data because we've looked for the data to try and understand better the solutions. And we're not finding as much information as we need. And I think we need to unpack where those gaps exist.
Okay, thank you very much, Mehnaz. Very, very clear, very clear. Thank you. Now I turn to Greta and also Smita. You see, the microfinance, women are doing exceptionally well. But when we, when it comes to enterprise financing, the same set of financial institutions see high risks in women-led SMEs. And they, as Greta was pointing out, it could be related to collateral, it could be related to belief in their capability, women's capability in managing their enterprise, or so they want the guarantee from men. And now increasingly in Indian context, the first loss default guarantee is a mechanism which is sought after. So why, the microfinance gives comfort, whereas enterprise financing is not happening in the similar lines. So what do we need to do as a country? Do we have examples, Greta, from Africa or elsewhere, where you have had a similar mechanism where women were part of VSLAs or the MFI ecosystem, but they could graduate to become individual clients of banks and get larger credit? Thank you. Then I'll turn to Smita.
Yeah, thanks a lot. If I could maybe back up and talk briefly about the data point that Mehnaz made, because I think that's actually really important to answering this question. And I guess I think of data in a little bit different way, largely in agreement with Mehnaz, but I think data can be generated in multiple ways, and you kind of need those multiple points of view to give yourself a complete picture of what's going on, right? So you can create demand side data sets like the Findex, or supply side data sets like the annual GSMA industry data. Happily, those generally match year on year. And that, I think, helps you understand a lot better what's going on globally in terms of financial services. So, you can build country level data sets that tell you what's happening in credit markets in a country. And, Peru is probably one of the best countries I've seen for doing this. They have the most amazing data set on the credit market, not sex disaggregated. Chile has been doing sex disaggregated data for 20 years and have really robust data on what's going on there. And Mexico's now jumped in and sort of imitated that. That's the public data sets. But then I think, this issue of private providers using data is really pertinent, and it's really relevant for the microfinance sector, because, hey, guess what? Google knows more about me than my husband does. right? And so there are companies out there that, by the way, are putting data or credit into their business models who are heavily data driven. And so if the more traditional microfinance, bank sectors, et cetera, can't get their heads around data, they are going to be left behind. And I think that has really interesting and scary sometimes connotations, as we've seen sort of in the growth of digital consumer credit in East Africa, for example. And so, and looking at embedded finance, where there's all kinds of stuff going on. So, I think we have to really get our heads around this data issue. But like, I think the question you're asking sort of speaks to this transition between, or from group lending models to individual liability credit models, right? And there's a lot of history on that one too. So there are, without a doubt, institutions who have made that transition, right? If you take a look at the history of microfinance in Latin America, that is the story. They started out with group lending, and they now have, individual liability lending models mostly across like the Andean region. Mexico is a little bit of an outlier, but you look at Colombia, Peru, Bolivia, these are super sophisticated microfinance models that have really well differentiated levels. In Peru, some of the biggest microfinance institutions are commercial. They're owned by the biggest banks in the country. You still have NGOs working in very rural areas with group lending methodologies. That said, making that transition from group lending to individual lending has been difficult. And that's partly because microfinance institutions are not great at doing data. And it's hard to do data when you have a group and then turn it into an individual kind of relationship. And I think it's worth thinking about this and thinking about business models as policymakers look for ways to build those on-ramps from group to individual lending. So microfinance at its heart involves a really delicate balance between keeping the cost of reaching low-income populations as low as you possibly can while retaining good credit risk management and loan servicing practices. And maintaining that balance as you make the transition towards individual liability loans is really important to the health of the institution. And it's frankly been a stumbling point for many MFIs. The skills, the tools, the structures you need in place for each kind of lending are totally different. And if you've built an institution where your staff are used to working with group methodologies, then it's a big shift. It's a big change management process. You have to train them, and you have to build new kinds of structures that enable that shift to individual lending. Loan ticket sizes are larger, so that increases risks. Do you have the data to be able to actually see that risk? And then the cost of servicing those individuals is much higher than for groups. And ultimately, the relationship with the client is fundamentally different, right? And so I think there's a whole process that has to take place to move from those group liability loans to the individual liability loans. And I think public policy has a really important role to play in this, right? So the regulatory environment, as I was saying before, sort of shapes the whole market. And again, I think Peru is a really good market to look at. They have an amazingly dynamic microfinance market because they have a regulatory framework that enables institutions to progress along multiple stages along the way to a full banking license. So you don't get institutions that are stuck, this is what you do, this is what you will always do. Instead, the institution has a pathway to say, right, okay, I started as an NGO, I want to grow up to be a bank when I grow up, right? So if you take the case of Edificar, Edificar was created by CARE in Peru years ago, decades ago. Edificar is now owned by Banco de Credito. It's the largest bank in the country. Along the way, there were multiple steps they took. They got permissions to do more. They got, a different kind of regulatory license. It was a clear, understandable pathway, and they walked that pathway. And so I think that's a really good practice in terms of helping institutions grow up with their clients, because what they did is they brought their clients with them, and they were able to kind of distinguish between who were good credit risks and who weren't, and they could grow with their clients. Whereas I think the risk in India is that you have kind of people who get stuck in ghettos, right? They're stuck in the self-help group ghetto and they can't break out. They're stuck in the microfinance ghetto, they can't break out. So, I think a little bit more, and I think this is a little bit the downside of the sort of heavy government engagement on the wholesale funding side, which I actually think is also really interesting and useful for other markets, but it has so many strings attached. It's super frictiony to get loans through that, which is why the private sector is not participating, and you rely heavily on state-owned banks. But it's a really powerful way of getting affordable wholesale funding into the market. Like I said before, African MFIs would give their eye teeth for that kind of access to funding. It's a huge constraint in Africa. And so, I think there's power in that, but I think you have to be cautious that it's not creating these kind of siloed ghettos where people get stuck and they can't kind of grow and move up. And the capable micro entrepreneurs can't kind of break out of that. So I would take a look at that.
Yeah, thank you, Greta. Thank you very much for those insights. Smita, I turn to you, Dr. Smita. You have been part of this journey of SHGs as well as this JLG model in India. You have also had a very good experience of working in other countries as well. What are your key suggestions in, how do we address this transition from typically the group lending to individual loans?
Yeah, thank you. I think Greta has given a pretty good start to that, and I would agree with everything she said. But I think it's also very important to say that, given that in India there are two models, we need to have different pathways for the two models. And also for the micro entrepreneurs who are not transitioning from the SHG or JLG model, it has to be a third pathway. So there have to be three pathways. And SHG bank linkage through the bank linkage model, I think, clustering them, making federations. So we haven't worked on this scale thing, right? And you know very well, Girija, because you have studied federations in great detail. Federations in India have never really taken off to the scale that they should. And the importance of NGOs or EFAD plus MAVIM kind of programs, the state government with EFAD or World Bank with another state government, these are very important in pushing women through the line. Otherwise, you don't get them, they get blocked. So SHG bank linkage needs to see scale up through aggregation, because more and more banks will not give only to SHGs. That is falling. What Mr. Kaushik said, unfortunately, he's gone, but it's very true that the co-lending model has a lot of scope and will develop and will provide a sequential pathway. But what I do want to say is, when it comes to, let's say, the kind of loans he spoke about in Mudra, you see the same glass ceiling problems. So you see that the Shishu loan, which is the smallest, less than 50,000, is about 66%, so 2/3 of the portfolio. Then you go a bit higher, you go to 50,000 to 500,000 loans, and that's about 25%. And then you go on 500,000 rupees and more, and the percentage drops to 11%. And again, there are two issues. One is that people really don't think women should get higher loans. In a group with group liability, you trust them. But the moment they become individual, then you want collateral, and something that Mehnaz was so passionately saying, like, why can't they move beyond the mindset of collateral, for heaven's sake, right? So they don't do that. So part is mindset, but part is also regulatory. The Reserve Bank of India has mandated that NBFCs can give only 15% of their loans as individual loans. So even if more can move forward, 15% becomes a constraint. So I know that Reserve Bank of India has put out a consultative paper, and I'm sure in the financial summit now, IFI summit, that will be discussed as well. But I think a lot of these things the Reserve Bank of India is now thinking about relaxing. But I'd still not like to end just by saying things are on the positive track. There are big important constraints which need to be broken. And one of them is the government being able to mandate that, listen, every year, like you were also saying, and Mehnaz was also saying earlier, every year we should see a 5 to 10% increase in loans going to women entrepreneurs, whatever category, doesn't matter. But that kind of policy thrust has to come.
Thank you, Smita. Thank you very much for those, clear direction in which we should be moving. There is a question from the audience to Greta and Mehnaz. Have you come across any unique models from the other developing countries using the alternative data points, like Internet of Things driven models, for graduating the early stage women entrepreneurs to high ticket lending?
I'm happy to come in on that, but maybe I can just build on something that Smita said that I think is actually really important. I always talk about Peru as kind of best in class for regulatory framework. One of the reasons they have that is that there is a constant conversation. First of all, they have a superintendencia that is focused on inclusive finance. They have a banking superintendent, but they also have a superintendent that looks at microfinance. And they constantly talk to industry. So the point Smita was making about the dialogue, and I see that in India too, it's super important because then you can course correct. Payments banks, they didn't work out so well. So, you know, small finance banks win the day, right? And so I think for a smart regulator, you have that conversation with industry and you adjust as you go along. And that really helps to solve a lot of the problems and pain points people are seeing in the sector. On your point about alternative data, there are lots of experiments with alternative data. I haven't seen any that have really got to scale because ultimately the data that really matters is the non-alternative data, and a lot of lenders still are using that, right? And so I think there's a lot of data. It's figuring out which data is meaningful, and we're seeing a lot of interesting scored kind of models. I think a better way, you know, I think alternative data could be interesting as a kind of gateway proposition, but at the end of the day, it's about ability to repay and capacity to repay. And so there's so much more power in looking at the data streams that are coming out of the billions of payments that are running over UPI. I forgot to mention earlier, really important data change that's coming in India, and you guys are at the cutting edge of this along with the European Union, is personal data, right? So data aggregators where people can actually command and control their personal data is going to give much more meaningful data, but also kind of data integrators. So, you know, again, not Facebook data so much, but like, do you pay your electricity bill? Do you pay your water bill? So using APIs and kind of being able to integrate data sources, like we're seeing a lot of providers starting to do, is going to be really important to creating that kind of rich environment that tells you, can that person pay or not? Because you're right, Mehnaz, you know, like the focus on collateral is sort of, you know, 20th century banking. We have so much information to work with now. And just to kind of leave you with one model that I think is a really interesting one, there's a little company called Yoko in South Africa that does basically merchant cash advances, right? So you put a payment terminal in a small business and you then know exactly what they're selling, and you then can take your payments off the top when they're doing it, right? And so I think there are a lot of different ways that you can connect payments with credit and have very rich credit decisioning that doesn't rely on who you're friends with on Facebook, because the other challenge is that so much of the information on Facebook is fake, right? So, you know, I think it's a nuanced space, but I think data is fundamental, but I think finding the right kind of data that really tells you something about that person is key.
Thank you, Greta. Over to you, Mehnaz.
So of course, I actually agree with everything Greta just said, as always. But maybe if I could just go back to a comment that Smita made, and I want to bring in the concept of risks. So right now, we're only talking about constraints and how we have to do more to help women access, you know, credit and other financial services. And when you start marrying that with data, actually, you create risks. And even with public policy, you create risks. And I'm going to give you two examples, because we need to be very thoughtful and careful when we make recommendations. The first example is I worked in a country, not to be named at this point, where there was a mandate for the microfinance institutions to lend to only women. And this, of course, was done with the best of intentions. And as we started working with some of these institutions, we realized that actually, even though on paper they were all women and they were 98, 99% women, actually, it wasn't close to that. It wasn't even close to 50. It was like 20%, and the rest were all the men. And what was happening is the men were taking the loans and the women were forced to repay, and they were the ones bearing the lack of repayment on their credit history, and the men didn't have to do anything. So we need to be very careful, Smita, and I would say this, especially, you know, lots of unintended consequences in well-meaning public policy. And the second risk I would kind of call everybody's attention to, including me, I always have to remind myself, technology and data carries really big risks for consumers. And in another country I worked at, well, this one I think is better known, but in Kenya, the technology and the data got so good that actually you could have small micro entrepreneurs getting a loan in the morning and repaying at the end of the day, all digitally, because of course there everybody's connected. And that sounds good. And actually it was helping them. They were kind of daily traders. The interest rate margins were unbelievable. And if there was even one missed payment, it completely went on the black side of their credit file, because there was also no alternative data to look at kind of the other things that were actually helping them repay. And so we found that women were going into incredible debt and their credit histories were being ruined. And that was, something for the regulator to deal with. But again, unintended consequences of kind of this new frontier we're in. So let's also, we should all be cautious when we start thinking about the possibilities that there are also downsides to achieving this.
Yeah. Thank you, Mehnaz. I think, at one point of time, it looked that, 75% of these alternate data-based lending ran into some amount of delinquency, and the credit history was showing very badly for these clients in Kenya. Thank you for that a warning, and also, how we could use data in a much better way. Ladies, we are coming to the last question. The time has flown by. I wish we had another half an hour at least, but we come to the last question to all of you. What is your take on top 3 policy priorities in making adequate financing for women enterprises a reality? First, Greta.
Okay, I'll see if I can do this justice. And a big +1 to Mehnaz on her point on consumer protection. It's huge. And as we move into embedded finance, you have a situation where people actually don't even know they're taking a credit to buy something. And so I think we have to be really, really attentive in a data-driven credit environment to consumer protection risks. So what are my top 3 policy priorities? Obviously, I'm going to say data, data, data. I can't say data too many times. It is and will be the driver of credit decisioning for years to come. And if you don't get on the train as a provider, you'll be left behind. And if you don't get on the train as a government, you actually won't know whether women are being left behind or not, and whether you can do something about it. So smart investments in data are a no-brainer from my perspective, and I think India is doing a good job on that. Second point is, I think regulatory frameworks that are more nimble, less siloed, and allow for step changes in access to services, recognizing that customers sit along a spectrum and can graduate from one step to the next. Make it easy for them to do it. So, get the institutions sort of working a more nimble way so that customers can grow with them. If you put the customer at the center of policymaking and delivery, you really can't go too wrong. And then I think the last point I would say is non-distortionary public sector engagement. And that's where I think the world has lessons to be learned from India. I think there are some things that end up being distortionary, to Mehnaz's point about good intentions going wrong. And I think it's important to be attentive to that. But I think India is getting a lot right on this, right? So others have mentioned, and I will jump on the train on this, the technology infrastructure that is being built in India is world-class. And I think there's a lot of learning to be done there. And I think a lot of countries really are trying to imitate that. So I think there's a really important piece there on market infrastructure that also can't be emphasized enough. I think that is almost table stakes to play in this, in the new kind of economy. But I think the other pieces around this wholesale lending and directing productive resources into low-income segments, because basically supporting low-income households is really hard, and supporting women is even harder. The economics can be really difficult to stack up. And so I do think specialized lenders are important because they are fully motivated and focused on that task. Banks just do not have that interest. A bank always has better uses for their balance sheet. That's not to say I think we should have women-only MFIs, because I actually think Mehnaz's story is quite a good cautionary tale. I think specialized institutions looking at the low-income segment are important. I don't think we should let banks or microfinance institutions or anybody else off the hook in terms of serving women, because women are half the population. They sit in many different segments. And so I think it's important to have specialized institutions, but it's important to be thoughtful about what they are. More important is getting that liquidity into the system, which I think India does in a really interesting way.
Thank you. Thank you, Greta. Mehnaz? Quick points. Top 3.
Can't you put like 2 speakers between her and I? She always has the great ideas. So I don't, 3 is really a tough number. I'm going to take Greta's idea of specialized institutions, and I'm going to say, take the specialized institutions and figure out how to scale them. And India has an amazing opportunity with its public sector banks. The regulatory space has just opened up in the past few years for co-origination of loans, for example, and blended finance models, and a lot more could be done that way. And I would also say there are some amazing MBFCs in India's market that are really pushing the frontier, that don't have access to market capital, for example, that don't have access to, lenders of last resorts, that are really kind of left hanging in the financial sector without kind of the normal safety nets that a lot of banks have. So I would just take hers and tweak it a little bit. The second I would say is going back to my pipeline issue, which we didn't get to talk about very much. One interesting thing, the pandemic has been really hard on women-owned enterprises, this we know, but it's also caused a lot of changes in entrepreneurial behavior, including within women. And the uptake on digital payments, on digital marketing, on e-commerce that has happened has been phenomenal and way exceeded anything that we could have, not the World Bank, but even public policy, anything. The ecosystem just took a fundamental leap forward. And I would love to build on that in terms of strengthening their ability to be more productive. And in this case, I'm not necessarily talking about the lower end. I want to spend some more time talking about the small and the medium end. So I would really, put a big push for expanding the pipeline. And then I'm just going to say the word data one more time, and then I'll be quiet. I won't say it again for the rest of the night.
Excellent, excellent, Mehnaz. Smita, over to you, Dr. Smita.
Thank you, Girija. I think, data, of course, but that doesn't count because others have already said it. So I'm going to do my 3. One is definitely organizations to help grow women's businesses. Because I think from women's point of view, they need a lot of support to be able to grow. We've heard from all the financial institutions that offer non-financial services, that business counseling, helping them to do compliance, helping them even to do simple things like, working capital credit, where they have to keep inventory logs and things like that. Women have to learn new skills as they grow, and that's really important. And I think I would go back, I may differ slightly from Greta in this, or Mehnaz, but I do feel that the women-oriented or women-focused institutions have done an amazing lot that other institutions have not learned from. And they are still the ones breaking new ground every single time. So I think in India, it's very important to give them prominence, to learn from them, to bring public sector or even private sector organizations together to see what they're doing that can actually be learned by the rest. And then I think at the public policy level, definitely monitoring one metric of how much finance goes to women's enterprises and across sizes is really important. So even though, and I think Mehnaz's qualification of this is very right, that a lot of money going into women's hands does get taken away by men and so on. And this is a problem that in Bangladesh, especially, microfinance institutions are just beginning to address and design gender transformative programs. But that apart, still, I think this is really important for public policy to push, because it's important to, it's very easy to find out which enterprise is women managed and which is not. So it's still possible to push for that.
Thank you. Thank you so much. I think I have received a reminder from Minal to close. Thank you very much for a wonderful discussion. And I'm not going to sum up. My only one metric which I would like to follow is 40% women-owned enterprises coming up in the next decade. That is a metric which I will root for. Thank you very much. Thank you very much, Access Assist, for a wonderful discussion around the study report. We would like the report to come up very well and then to be disseminated so that we make changes. and for more meaningful financial services for the women entrepreneurs. Thank you, Greta. Thank you, Mehnaz. Thank you, Dr. Smita. Pleasure also.
Thank you.
Yeah.
Thank you,
Thank
Girija.
Thank you very much.
Thank you, everyone. Thank
Girija,
you.
for navigating us so finely through this very important discussion. We have all sort of said that yes, there is a problem. So that's a positive note where we start. And just taking a cue from what we have learned from microfinance is like we need to move from being first users to repeat customer kind of language. We need to move from customer satisfaction to customer delight. I think if the supply side chain start thinking about these words, probably things would start falling in place as well. So thank you, Greta. Thank you, Girija. Thank you, Mehnaz, and thank you, Mr. Kaushik is not with us, and Dr. Smita for this wonderful discussion. And yes, we close this discussion. We thank the audience as well for participating. And I think it let all of us thinking a lot about what need to go ahead, how we need to go about, So yes, and do join us for a very special address by Shri Montek Singh Ahluwalia in Hall B, and we look forward to you all joining there. And thank you very much again, and wishing you all a very pleasant evening. Thank you very much.
Thank you, Meena.
Thank you.
Thank you. Bye.
Thanks, everyone. Thank you.